Hey guys, welcome back to another episode of Market Grinders. Today, just want to kind of speak with you guys about some of the things that help make us better investors. Right now, there's a lot going on in the market, right? We have the AMC situation going on. We have still have the GameStop situation going on. We have oil starting to turn back around and do well. We have some of the EV plays starting to heat back up. So lots going on in the market, right? So the biggest thing about the markets is our thought process and how we plan around these things. These things are always going to happen. You're going to have things going up in the market. You're always going to have things going down in the market. So we have to have a good strategy. So today I want to kind of go over about 4 things that we should think about when we're making investments in the market. And these things can help us sustain gains in the market, because the way I think about the market is you don't want to lose big. You want to win big and lose small. Losses are going to happen, but you want to mitigate those losses. One of the better ways to mitigate your losses is, for one, knowing your investment. So if you choose to invest your money in a company, you should know what that company does. You should know that company's chart. You should know how many employees work for that company. You should know the seasons that company is more profitable than not. And there's other things that we need to know as well. But just knowing those small things about a company, it gives us security when the company stock drops, and it will, right? Everything that goes up does come down. So when that company stock starts to go down, we don't panic. We understand that, this company stock is going down because it's summertime. They make cold and flu medicine. So now is a great time to buy more shares of this company, so that when cold and flu season starts and their stock increases, I have more shares, therefore I make more money in the end. So that's one thing that we need to know about companies, is know our investment, know these companies, know what they do, know their people, and know it like it's your business. Another thing is, don't fall in love with a company, right? So have a plan for your company. Whichever companies you choose to invest in, have a plan, whether it's a short-term investment or a long-term investment. Don't buy Nike. Do buy Nike. Nike's a good stock. But don't buy Nike without a plan. Don't jump in and say, I like Nike, I wear Nike, so I'm buying Nike, right? So you buy Nike on, Nike just had their earnings. They did well. The stock had a nice increase. So you jump in and buy Nike on that increase, thinking this is a great company, and then in 2 to 3 weeks, Nike starts to slowly sell off, and now you bought at the high and you're riding it back down to the low. That's fine if you have a long-term investment, but if you bought Nike and you wanted to own it for 2 weeks, and you saw Nike started to drop, you sell it and you get out, right? Don't fall in love with the companies. Understand the fundamentals, understand what this company does, and understand what your plan is with this company. And when this company no longer fits your plan, you should sell that company and choose another investment, because at the end of the day, we're investors to make money. We're not investors because we love companies. And it's fine to love a product from a company, but once that company starts to show signs of weakness, or that company starts to show signs of change that aren't in line with making money for yourself, you have to take a realistic look at that company and be willing to sell that company and take your money and put it in other places. Another way to limit some of your gains is hopping in and out of stock too fast, right? So I'll still use I use Nike as an example. So I bought it at 120. It went up to 110. In a week, I sold it. I bought Adidas. Adidas went to from $50 to $60. I sold it. I bought Under Armour. You know, jumping in and out like that does not really help you, because you don't have enough time in the market to grow your gains. So there's a saying that time in the market beats timing the market, right? So meaning that if I put my money into an investment and I leave it there for a long time, it's been statistically proven that you are more likely to see success over a long period of time rather than jumping in and out of individual stocks. That and not to 100% take everything away from that, but there are many traders that do that, but jump in and out of stocks. But you also have to be strategic about when you're jumping in and out. You also have to be strategic about what vehicles you're using as you're jumping in and out of stock. So if you're using options, great. If you're using futures, great. You know, but do your research, do your homework, and understand when you're getting in and understand when you want to get out, and have a solid plan to do that. And that's more so trading, not investing. Right now I'm talking to my best investors, people who are looking to limit their risk and make more gains long term. Those are our investors. So, you know, find a good company, do your research, buy your shares. You know, you want to have a substantial number of shares. You don't want to get caught into buying 1 and 2 of everything. You know, set you a goal, 100, 200, 300, 400 shares of this particular company to have, or set you a dollar amount. And just this is just an opinion of mine. Your dollar amount should be at least $2,500. You don't have to spend that all at one time, but you should at least say, you know, over a course of 1 year, I plan on putting $2,500 in XYZ stock. And that's not to say that you have to have $2,500 to get into the market, because you don't. You can get in with $5 or $10, but you want to do that over a period of time so you can build out your plays, so that when you do have those run-ups, now you're having a run-up on 100 or 200 shares rather than having a run-up on 1 or 2 shares of a company. So it makes you more money, and as an investor, we really have to start thinking about things that way. How do we make the most money? And one of the third things that I want to speak on is being patient. And patience is very, very, very important in the market. So, for instance, Nike again, right? So, if I think Nike is a good company, and it's at 130, I think it's a great company. But now I got to be patient enough to wait for it to pull back to 120, so that I can put my money in and get a little bit more for my money. Now, as we do this over the course of a 1 year, 2 year, 3 year, 5 year period, getting in at the lowest price, that gives us the biggest gains over time. And these gains are exponential. Don't never take for granted that getting in to a company at $5 or $10 cheaper is not a big deal, because it is a huge deal when you talk about number of shares that you get, and when you talk about compounding interest. So it's a huge deal. So just keep those 4 things in mind. Know your investment. Don't fall in love with the company. Have patience, and try to avoid hopping in and out of stocks as an investor. So I want to keep this video short and sweet. If you guys have any comments, please leave them below. Don't forget to like, subscribe, and share. If you guys are watching this video on Facebook, and you share it on Facebook, please go in to YouTube at some time and set up an account so that you can actually engage with the videos. You can you can share the video from YouTube, and it helps out with the channel when you guys are, watching the videos through YouTube rather than Facebook. But I'll continue to share on Facebook. But anybody's watching on Facebook, please go in and follow us on the YouTube page. So once again, I appreciate the time. Hopefully you guys got something out of this video. I wish you guys well. Please continue to build wealth and keep grinding.